Hi, folks. Thanks for joining us today at Your Economy, Your Credit Union. My name is Rob Eyler. I'm a volunteer official on the board of Redwood Credit Union in Northern California, and I'm also an economist and a professor at Sonoma State University here in California in economics. And so today we're going to continue our series of interviews of credit union executives throughout the state of California. And I have with me today Michael George from Safe One Credit Union, Brice Yocum from Tucoemas Federal Credit Union. I knew I was going to screw that up regardless of what you'd said. And Nick Ambrosini from Valley Strong. Thanks, guys, for joining me today.
Thank you for having us.
Thank you.
Of course. So our focus today is on the Central Valley economy and kind of what's been going on with credit unions in the Central Valley. So the first question I have is, when we think about where things have been going from a loan and deposit standpoint, is there anything that stands out in the Central Valley that is good or bad in terms of the evolution of loans or deposits in your mind versus just been what's going on with rates and the general macro environment? And Michael, we'll start with you.
Sure. I think we're talking macro and on a national level, of course, inflation and price increases, they're not just in the Central Valley, they're everywhere, and they've been impacting everyone nationwide. In terms of the Central Valley, the southern part of the Central Valley is unique in the sense that oil is still very big here. Kern County has a very diversified economy, but oil has been impacted based upon what the state's mandated, new rules, new laws. And so we have seen some people in the oil industry, lose their jobs. There has been some cuts. We had 3 oil companies here in Bakersfield that had recent cuts of a substantial amount, 8 and 10% of their staff that's been cut. So we've seen that. The other thing that's looming is that there could be a possible Kaiser Permanente strike. So we'll have to see how that impacts people, not just in the southern part of the Central Valley, but throughout the Central Valley. What areas are more impacted than others remains to be seen, but that's something that's looming. And the other thing that we've seen really is that, some companies have really laid off, at least in the southern part of the Central Valley, small layoffs. So 5 to 10 employees, maybe early retirement packages as a way to control costs. So, that impacts those employees, but it also impacts the entire community. So from a Central Valley standpoint, those are some of the unique things at least we've seen, in addition to, like I said earlier, the bigger picture being inflation.
Yeah, and that inflation thing, no doubt, is obviously a general issue. It's been intriguing to watch how at least some credit unions have seen more of a pinch on that than others, if you look at the data. But that figures because in some cases, some are a little bit set up better from a balance sheet standpoint in terms of going into this space than others. Brice, what about you from what you're seeing?
Yeah, that's a great point. So I think we, as opposed to the other two here, we are just in Tulare County. So we tend to feel like that in a more hypersensitive way. And Tulare County, especially for our particular group of members, as from the pandemic forward, as those sort of federal supports and additional state payments started to dry up, we have definitely seen a change in our assets back to being more cyclical. So for a while there, we were holding steady. We weren't having any problems at all with asset quality. Now we see our assets starting to drop off again. There's some challenges around asset quality. And I think a lot of that for our member base anyway, is the fact that instead of us having, one unaffordable $400 expense a year, our members are having that every single month. And they're not getting additional support from the government. And it's a very ag-centric and service-centric economy. And so you have, skimflation, people are hiring less employees, hotels are offering fewer services. So there's income issues, there's savings issues. And for us anyway, it's been pretty dramatic.
Yeah, absolutely. And I think the thing that I try to tell groups when I speak with them is inflation is a regressive tax. So not only are your small, like lower to middle income households pinched the most when inflation is rising, but also your small and medium-sized businesses.
Yeah.
And so not only from a sort of a classic member standpoint, from a member business lending or just a member business and merchant services standpoint, we've got to be thinking about that as credit unions also.
Yeah.
Nick, how about you, Valley Strong?
Yeah, so we serve 5 counties: Kern, Tulare, Kings, San Joaquin, and Solano. That's where our actual retail footprint is for branches. And each market is very different than the others. I'd say where the biggest concentration of our membership and deposit base is in Kern County. For the most part, things continue to be good. There's still a lot of commercial development going on in the, lower Central Valley, bringing, a lot of construction jobs, new industries. We're in this kind of redefining who we are. Mike mentioned the oil stuff, but we're slowly trying to figure out what that new, what that post transition is going to look like. How, we're looking at carbon capture, a lot of new industries, a lot of new federal and state money coming, since there is such a, concentration of engineers and people who can help solve some of these, statewide initiatives. So we're kind of transforming ourselves, I think, in the lower Central Valley of what the new economy is going to look like.
And Nick, stay with you for a minute. In what ways has Valley Strong thought about in the midst of that transition? Are there other products or things that you guys are thinking about that might be good for members as they kind of move through this time? Perhaps in some cases on the business side, you're going to see some industrial mix changes, or at least a little bit more maybe out of the box thinking on economic development that might affect the type of member business lending you do. Are there some things you guys have been thinking about from a product standpoint that might address where you're going, not now, but 5 years from now?
No, absolutely. So we recently became a CDFI, and the purpose of our CDFI is extremely narrow focus. It's on business formation and early stage startup businesses. So 100% business focus of that CDFI. We're in the process of standing up a revolving loan fund. One of the things that we know is access to capital is so important for not only business formation, but a business, staying in business. We also participate if there's a public-private collaboration in our county called B3K that the county and the city and several other stakeholders are involved in. It was a big market research done by Brookings. We have a seat at that table, which is really interesting as well. If we're looking at what sectors we really want to try to bring to the market, advanced manufacturing, aerospace, business services, energy and carbon management. Those are really the big sectors that kind of multifaceted group is looking at bringing to the market.
Cool. Brice, what about you?
I think, we've kind of looked at it predominantly, obviously for Tucoemas, we're very much a retail focused credit union. And so we've been looking at what can we do to address the issues for folks that are really impacted by a lot of this sort of economic challenges. And so we've been looking at things and implementing things like small dollar lending, building programs to try to build sort of financial ecosystems around people. So a couple of things that we're focusing on right now, with all of the new sustainable groundwater things coming into place, the Tulare County area is going to be impacted tremendously by a lack of water availability and needing to move to more sustainable agriculture. And so I was looking at the report earlier today, Robert, and I'm not really sure that the ag industry is going to continue to be safe from some of the downturns that are happening in the economy. And I think just looking around my house, we tore out 20 acres of trees and my neighbors are tearing trees out everywhere. The trickle down effect of that for ag services and folks who need to get a different education, move into different industries, there's a lot. So focusing on sort of helping people with bridging those capital needs, and then also looking at our aging population right now and trying to build programs to support them from elder financial abuse all the way through housing needs, and somehow figuring out how we're going to have enough trained providers for the aging community. That's the biggest growing cohort for us, and they have huge needs. So doing some things and looking to do others.
Yeah, and I think one of the things from a demographic standpoint that I wouldn't say that we've sort of shut our eyes and our ears to over the last 10 or 15 years, but that we're now really seeing spill over us is this aging cohort coming through and needing maybe a completely different array of products and services that we didn't even think about 10 or 15 years ago, which now is very important looking forward, especially if they end up living 10, 12 years longer than we originally expected.
Sure. Perhaps
because of the wealth they've derived, they've been able to extend their lives. But what's that mean for them on the other end of that? And then, how do they see their consumption pattern happening in such a way that they might need they might have little bridge needs over some of the bumps in the road?
Yeah, absolutely. And most of them want to stay in their homes. And so how do we provide the qualified care for them to be able to do that? Where do those expenses get covered? It's there's a lot of questions.
You bet. Yeah. Yeah. When other ones that haven't even been asked yet that we need to answer. Michael, what are you guys doing at Safe One?
Well, it's interesting that you're talking about the population getting older, because that's absolutely true, and that's something that has to be addressed. One thing that's unique to Kern in the Central Valley, and this started happening before the pandemic started, is that we saw a major influx of millennials and Gen Z coming, mostly millennials coming in the area. I think Kern County at one time was the ranked second nationwide behind Riverside County in terms of millennials moving, because compared to other parts of the country and California, we offer affordable housing. There's more and more work that's done remotely now. And so we've seen that. I can tell you, like with our credit union at Safe One, 50% of our membership was born after 1980. And that's incredible for the board to hear a lot of times. Even our new members, every month, 60% are millennials and Gen Z. So that trend is just going to keep continuing. So it's obviously important that we offer products and services, not just for all our members, of course, but with those numbers that I just told you, it's important that we address that group. So the one thing we've been fortunate about here at Safe One is that we have those products and services, a lot of them already. We offer the free checking with the no monthly fee that age group wants. We have the direct deposit. They get it early, up to 2 days early. They don't have to sign up for it. They have that. Grace on courtesy pay, all those sorts of things. We have Roundup to Save, Zelle, because more and more, it's incredible over the last 18 months to see a doubling of the number of those transactions and dollar amounts that people are using. So it's important that, first of all, we have the products and services that they look for. And so we think we do with that, as well as, great auto rates, great mortgage rates, especially when they're coming into the Valley to live long term. And so as we move forward, obviously we know the technology products are going to be very important, but as we offer those, what's even more important is that we do it in a way that's affordable to those members. And so that's where we find ourselves. When you say, what do we see 5 years from now? I don't know. Let's worry about what's just a year away, and then we can worry about 5 years as we get closer, because the world's just changing so fast. People always say, what do you think your son's going to do? My son's in high school. I said, I don't know what he's going to do for a living. The job probably doesn't even exist yet. So the main thing is you got to be nimble, and you got to be able to adjust what's around you.
And it sounds like, to a certain extent too, you guys are bucking a little bit of a trend in terms of the age cohort you're seeing primarily come in. Some of that's a reflection of what's happened in the Central Valley over the last 3 years in just terms of population change across that entire I-5 Highway 99 stretch. But it's been kind of intriguing if you look at the coastline of California, how much different that's been vis-a-vis the Central Valley.
Absolutely.
Cool. Well, folks, we're going to take a quick pause on our discussion, and I'm going to transition quickly to some slides because, as a couple of you have alluded to, we have seen the San Joaquin Valley business forecast that came out of CSU Stanislaus, and I'm going to talk a little bit about sort of the macro trends that have been happening since that report, but then also I'm going to pull one thing out of that report that I think is kind of intriguing, given where we've seen recent macro changes. So I'm going to share my screen now. So when I usually think about the macro economy as an economist, the first thing I do, at least over the last 12 or 18 months, is look at prices. So this is the price index that the Federal Reserve is most concerned with, which is called core personal consumption expenditures prices. So when you think about the decision making, for example, last week that the Federal Reserve was thinking about when they looked at the latest inflation data, these are those inflation data. This is actually pulled right out of the binder of the FOMC when they're making decisions about interest rates. And the blue solid line is the actual data on a monthly basis, how much more in a percentage sense of shopping cart full of stuff that we buy every month cost this month versus last year this month. And that 4.2% in July is that inflation rate that the Federal Reserve is watching. So what core personal consumption expenditures prices means is I take that shopping cart and I pull food and energy prices out of it, and the change of that basket of goods and its cost 1 year ago to now is what we're watching to see, okay, is inflation rising or falling, and what do I have to do with rates? Those red dots in that shaded area are the forecast right now in terms of where the Federal Reserve believes, A, the macroeconomy is going to drive prices, but B, their shaping of the inflation situation through higher interest rates and perhaps lower interest rates over that horizon will kind of move through toward that blue dotted line, which is the inflation expectations the Federal Reserve wants to achieve in the long term. And you can see from 2007 to 2021, about April, before we had that rocket ship movement up on the right-hand side, of this graph, we kind of wobbled underneath that in the wake of the Great Recession. And we had an amazing decade in terms of inflation control and the recovery period, even though we really paid for that in the detritus that was created from the Great Recession. So now we're, in many ways, at least this is my hypothesis, we're paying for some of those gains now on top of what we did as a result of the pandemic, and we're still coming out of that. So in many ways, this is still a shadow effect of the pandemic. So we're watching things like whether or not these prices are going to continue to have downward momentum, whether or not we'll see job losses. So one thing that's kind of hidden underneath the surface of the Federal Reserve's comments is that they want job losses to take place as a result of interest rates increasing, with the belief that those job losses will lead to a slower inflation rate as people lose their jobs and stop consuming as much. We will see if that's true. The labor market has not quite given way yet at the national level. Our small to medium-sized businesses, we kind of alluded to this before, on the business side are the ones that are most pinched. Inflation is a regressive tax, and we're starting to see that. If you look at your downtowns, if you look at your strip malls where there's local ownership, or let's say at least smaller to medium-sized businesses in those areas, vacancies are going up. Part of that's because that cost pinch is now starting to lead to profitability problems and an exit from the marketplace of some of our smaller players. Federal Reserve is not going to lower interest rates until they start seeing those job losses, and they feel like that momentum has played its way all the way through. So as much as we like to think about in the credit union industry, and this is also happening in banking generally, that interest rates maybe are almost going to go down, right? Does the Federal Reserve feel like it's a little bit more dovish in terms of fighting inflation? Until these data are actually moving through those red dots in earnest, they're not going to be. So we're probably going to be in this continued high rate environment for a little while. Real quickly on the rates. So economists tend to watch the difference between the 10-year Treasury and the 3-month Treasury as the marginally best indicator of potential recession. And over the last 13 recessions now since the Second World War, 12 of them have been preceded by a downturn below zero in that spread. And these data are the last basically 41 years of those data on a monthly basis. And you can see the blue line, which is tracking that spread, has crossed that red dotted line before each one of the recessions, even though you can say the COVID-19 recession was an anomaly. It seems like the time of the dinosaurs, but in 2019, we were actually talking about being on the precipice of maybe a light recession going into 2020 or 2021. And the Trump administration was jumping up and down that the Federal Reserve had to do something. What also might seem like an age ago is that the Federal Reserve cut rates 3 times in 2019, and then obviously took us down to the zero lower bound once the grip of the pandemic and our social decisions was made more clear. Now, this is the Federal Reserve's rate. So if you're a board member or you're an executive or you've seen rates shoot up, you know, you've done stress testing for years, 300 basis points, 500 basis points, and trying to say, wow, what's going to happen to our balance sheet if this happens? Well, now that 500 basis point shock has basically happened. That's that black line going straight up on the far right-hand side of this graph. But you can see that monetary policy has been kind of a mess in the 1980s and then finally figured out itself in the 90s and beyond. And we kind of thought we had basically cured a lot of the problems with inflation, the so-called Great Moderation period after the double dip recession in the late 70s and early 80s. We're now in, again, another really weird monetary time. So as that black line has shot up, that spread has been pulled down because the short market's rising faster than the long side. But you can see that little bit of curl, which is now in this gray area here, where long rates are starting to pick back up again, in a sense, chasing marginal yield that's starting to give way, and up we go on that ladder. So what does that mean? Well, if we look at the macroeconomy more generally, the forecast is the following. These data are from August 2023, and Federal Reserve in Philadelphia every quarter does an interview of 40 forecasters and asks, what's your median forecast this quarter, the new columns, versus last quarter, the previous columns, for a bunch of different variables. And I pull 3 of those that I think are the most germane to thinking about the macroeconomy. First one's real GDP growth. So think of that as income after we take inflation out of that income growth, what we really have to spend. And the unemployment rate is one indicator, which is somewhat flawed, but at least it's one indicator that we know members are going to be worried about with respect to the labor market. And then those same red dots, the core PCE, percentage change or inflation. Let's see what happens. If you look in the shaded area, you can see that the latest forecasts for these 40 forecasters has actually picked up for this year and next. So they've gotten a little bit more sanguine about where we're headed over the next couple of years. And then you can see for 25 and 26, it's flattened a little bit. But in general, these are not robust growth rates. We're sort of just meandering along, fighting inflation at the peak of the labor market and really not getting a whole lot of growth, but not also losing. So right now, we do not have a recession out there for most forecasters. There's a sprinkle of them that are out there suggesting we'll probably recess either in the fourth quarter of this year and or the first quarter of next year. But that window of 6 to 9 months of recession has been rolling forward for about the last 12 or 15 months from those forecasters, and they're starting to pick up how deep it will be and making it a little bit more optimistic. The labor market looks like it's going to give way a little bit in terms of unemployment going up. But if you're a student of economics, you know that unemployment rates of those low magnitudes are really nothing to worry about. They suggest we're basically swimming around full employment and very similar to where we were pre-pandemic. So not a lot of change. And the main driver in this is probably going to be a re-entry of workers in the labor force, picking up the number of people looking for work, not necessarily people losing their jobs en masse. And then, like I said, those are those red dots we just saw in the price graph initially. So overall, the economy has shown a lot of resilience, but so much of it's labor market based. And like I said earlier, the Federal Reserve is not going to drop rates until they feel very confident that the reasons why inflation remains at relatively high levels are starting to recede. And part of that, unfortunately, is lost jobs. If we get a little bit more focused on Central Valley and really kind of some comparisons around California, this is a look at the current housing forecast in terms of median home price. So these are looking forward 1 year from August. Now, why this is intriguing is two reasons. Is one, if I'd showed you the graph from 4 or 5 months ago, most of these would have been negative. And so we've gotten a lot more optimistic about housing, even with relatively high interest rates, which is a kind of a weird conundrum in the sense that we expected as rates went up, we would see a little bit more of a loss. And we have seen that realized in the current marketplace. But the supposition is with such low inventory and maybe with a little bit more optimistic forecast for the macroeconomy and this is where the trickery comes into the forecast, maybe slightly lower rates of interest in 24, we will actually see a little bit more action in terms of demand being greater than supply in housing markets, and up the ladder we'll go. So if you own a home, this is great. But if you're in the Central Valley and you don't own a home and you've been renting, waiting for that final price decrease while the getting is good, it hasn't quite happened yet at the magnitude maybe we expected. And we're still seeing people take on mortgages, even in a high rate environment, maybe under the supposition that rates are going to go back down again and they can just simply refinance. But we'll see how many people end up betting on that over the next 12 or 18 months. I want to show you that if you notice the counties that are represented on the higher end, many of those are Central Valley counties. And the Central Valley still is a place where people are looking to move. And you guys have talked about this off and on today so far as a place to go and work. What will be intriguing, and I'll ask you about this in a little bit, is that whether or not we see some remigration back toward urban California if employers who employ those folks that work from home suddenly say you need to be back at the office at least 3 or 4 days a week. There's a real friction happening in labor markets right now, especially around our larger tech employers, about whether or not they're going to need people to come back. Finally, this is a graph that comes out of the CSU Stanislaw forecast with the San Joaquin Valley. And if you look at what's happened basically from 2024 forward, 2020 was a pretty good shock, but that shock of negative 5.35% was actually better than almost every other region of California in terms of the residual initial impact of the pandemic. And the San Joaquin Valley very much led California in terms of jobs growth coming out of the pandemic. Now, twofold issues. One is we saw people moving towards San Joaquin Valley, which drove a lot of demand, drove a lot of construction, just drove a lot of positive change. And indirectly, what happened is that a lot of places in the Central Valley were not as tightly focused on the social restrictions as the coastal areas of California were. So there was a little bit more of a social experiment on maybe the more economic development side was, well, if we don't do this, maybe we won't lose as many jobs or as many businesses, and let's just kind of meander through, maybe not wearing as many masks, maybe not following as many restrictions. This was also followed in Northeast California and Northern California, thinking Shasta County and Butte County, and those economies came out a little faster from the pandemic than the coastal areas of California did also. But you can see on the far right-hand side, the next year and a half or so, what they call kind of 23 and 24, so sort of thinking the rest of 23 and sort of the first half of 24 as a forecast, more negative. This is they're kind of following that recession-ish look, but then coming out of it the following year or 18 months later. So the forecast is pretty good for San Joaquin Valley, and in a sense is getting a little bit better for the US and California overall, even though the urban areas of California have still got a little bit more of a quagmire to walk through before we actually get out of the current situation, because the inflation tends to pinch the urban areas a little bit more quickly than our more rural and smaller suburban areas. If you want to find out more from the league, E-Train is a great place to go. Please check that out. Angela Daly, contact her at angelad@ccul.org. She'll take care of you in terms of getting into the resources you need to learn more about what's going on in the industry and sort of the broader trends going on in the market. So guys, I have one more question before we wrap up. That question is about what you guys think is going to happen. So we saw the forecast. If you read that document, or at least looked at the overview of it, what you're seeing, Brice, to start with you, is there something there that you thought was an opportunity for the Central Valley and maybe the biggest challenge?
Yeah, I think if I was going to pull out one thing, and even looking at the report, I love the last paragraph in the report. The last paragraph in the report is basically like, build as much margin in your life as you possibly can. Rent, don't buy, be cautious, be in cash. And I think that's both a lot of wisdom, but also highlights, especially in the Central Valley, as all these folks think that Visalia and Fresno and the Central Valley is a great place to live, it's going to make it more and more difficult for the ag industry and service industry to live here. And so looking at the values of these homes going up, almost 20%, Madera, Visalia, based on the report, that makes it more and more difficult for the people that Michael was talking about to ever think about buying a home in the Valley. We're almost at $400,000 for the average median home price. And so from a credit union, there's a lot of opportunities for us to look at, new member growth, more affluent members, but also seeing those very fragile communities become even more fragile. And so how do we as a credit union step into that gap for our members and really be the margin that they may not otherwise have? I think that's going to be a big challenge for all of us, but I think that's why we're in the credit union industry, to meet those challenges.
You bet. And I think the Central Valley is unique, at least in California, in terms of the magnitude of change that's come to you all, in the sense the stratification of that change that's going to lead to challenges down the road, especially for credit unions trying to help both those audiences simultaneously.
Yep.
We're kind of seeing the same thing where I am too. And as a board member, we're always thinking about, well, how can we help the membership? But that membership has changed in some ways that will fundamentally change demand and perhaps really put more pressure on our lower to middle income households that's not relieved anytime soon.
Yeah.
Nick, how about you?
Yeah, I mean, I think there's a lot of opportunity in the Central Valley. I still think, you see all the commercial development, you see the people wanting to move, even though from a percentage standpoint, pricing has gone up quite a bit on housing. It's still extremely affordable. It's one of the few places, for the most part in California, you can still get homeowners insurance too, which is something that we haven't even talked about, right? There's a lot of areas where you can't have homeowners insurance. So I think there's a great opportunity. I think there's going to, in this current space, innovation on products will be key. I mean, if you could offer someone a low LTV interest only on a mortgage to get them in while they buy time to roll down, that's something that could be, meeting, a need with a solution, right? So I think there's an abundant opportunity for those who are willing to innovate and, do something non-traditional.
And we probably will see some more non-traditional tools, especially trying to help our lower to medium income households make that jump to home ownership. It'll also be intriguing to watch what happens with the types of homes that are built to sort of meet these regional housing needs, and how our cities and counties need to think about the balancing act between providing homes that are affordable, but also providing for a workforce that wants to live in those homes to then deliver workers to our major employers. And that, when I've done consulting, especially ones in which I've gone and spoken in front of city councils and boards of supervisors, that's usually where the disconnect happens and the major friction is that if you make these choices, you are in many ways making a community development and a workforce development choice at the same time.
No, absolutely. But there's so much money available too. You look at the state coffers right now, whether it's state money or federal money on infrastructure.
Yep.
If there's ever going to be an opportunity to do meaningful CEQA reform, it's going to be now, when their piggy bank is full of money to get shovel-ready projects.
Yeah, and as Gavin Newsom sees himself moving on from the governorship, whether or not he sees that as a strong goal to sort of leave in the wake those kind of reforms, we'll see. This is his big week to vote or to sign or not sign these bills. So it'll be intriguing to watch how that sort of sets up the political thing or political issues he'll have to face foundationally next year. Michael, what about you to wrap us up?
Well, we talked about how people have migrated to the Central Valley because they do it because they can enjoy a better standard of living, not just with housing, but all other costs as well. It's interesting, Robert, you raised an interesting point about, what happens when the workforce, if they have to go back into the office, and, my home office is in LA, but I work from the Valley. I think a lot of that will depend upon how frequently do I have to drive to LA? Is it once or twice a week, or do I have to drive in every day? Because that will make a difference on my standard of living and whether or not I decide to leave the Central Valley. I think in a larger picture, I think for credit unions in general, we just have to continue to remain doing what we've done to make us successful. The credit unions that are financially prudent in the good times, they're less impacted during the more lean times. So I know at our credit union, we really focus on keeping our operating expenses down, keeping a strong capital position, because when those tough times hit, you're much better able to adapt to them. And not only are you able to adapt to them, but in doing that, you're better able to serve the people, your members, who are even more impacted by what's happening in the economic environment. So, like I always tell credit unions, stay focused on what you've done to be successful. Stay focused on the products and services you offer the right rates, and you'll make it through any tough times.
Yeah, and I think a focus on the member at the end of the day, making sure that the credit union's financially sound is the main thing, right? So that you're seeing some credit unions that are now chasing that the level of deposits they need just to kind of rearrange their balance sheet, did not think about that previously, for better or for worse, and sometimes losing the focus on the member and worrying about chasing sort of the next shiny things, and sometimes get you into trouble.
Yeah, absolutely.
Well, guys, thanks so much for your time. That really is a great roundup about what you're seeing on the ground in the Central Valley and some of the things that are going on. I really appreciate your time.
Thank you.
Thank you, Robert.
Thanks, folks, for coming and checking this out. Take care.